So papers are due next Friday, so if you want me to mock grade your paper in class Tuesday or Thursday, let me know. If you want to send it in advance, that's fine as well. So we'll get some practice on that. Now we know for your paper, the stock market sold off a bunch, but now we're hitting all-time records. So obviously it's recovered since then. What did the Fed do last week? Cut 50. What did interest rates do when they cut 50? They rose. What does that mean? So that's kind of interesting. You know, markets don't always do what you expect. I was shocked on Wednesday that the market actually closed down. So it didn't actually rise until Thursday. Why did it take one day? What was the market thinking? So, you know, it's interesting trying to figure markets out. But talking about markets, let's start with bucks. Anybody remember what bucks stands for? Beta. US versus non-US. It'd be S and S. C is capitalization, which is really size. I mean, this last S is style. All right. For beta, y'all remember the two categories there? High beta and low beta, but what's another way of saying it? C and D. Cyclical and defensive, right? And what's your strategy if you expect a recession? You've got two things. Expect a recession, you want to do what with the beta? You lower beta by two ways. So reduce your stock allocation, and within stocks, what do? Move from cyclical to defensive. Okay, and that's a key phrase, within stocks. So you're going to see this, especially on the second question. So get used to that within stocks. If you're talking about this in an interview, you would say, hey, if you expect a recession next year, we reduce the stock allocation, and within stocks, the stocks that are remaining, we're going to reduce cyclical stocks and increase defensive stocks. We're going to go to lower beta. So we might reduce cyclical and defensive both, but we're going to do cyclical a whole lot more than defensive because our whole stocks is going to, we may go from 60% stocks to 40% stocks, but within stocks, defensive will be a bigger piece. So that within stocks is a pretty important term. All right. So here's my different industries, and everybody would disagree with this, but generally think about it. Energy, I think of as usually lower beta. Most people will buy gasoline for their cars. This isn't utilities. We're not talking about electricity, but oil and gas. Most people are going to buy gasoline for their cars. It is true if we go in recession, fewer people are working, so people aren't driving as much. Y'all saw what oil prices did in 2020. Anybody remember? Was that a good year for Exxon or a bad year, 2020? Pretty disastrous year. That was the first time ever in the history that we saw oil futures go to a negative amount. Can you imagine? Yeah, you could buy oil and they would pay you. So yeah, I'll give you 20 barrels of oil and I'll give you, $10,000. That was kind of bizarre. Why did that happen? Because there's no place left to store oil anywhere in the world. So, it was crazy. How did Exxon do in 2022? Pretty good year. Oil prices shot back up. So that's a little bit kind of, that sounds really volatile, but COVID was an unusual circumstance. Materials are always going to be high beta. Things like steel, chemicals, those are production. Anything that's in metal production, that's going to be high. Industrials, almost by definition, is high beta. That's building these massive machines or whatever. Communication services, that one's a little tough because they put telecom in there. Telecom historically have been low beta, but Meta, Google, or Alphabet, it's hard to say. So medium to low to medium. Consumer discretionary by definition, that's high beta. That's the auto producers, that's travel and leisure. Staples by definition is low beta. Healthcare, you would think it would be low beta, but healthcare is getting a little wacky here. So who knows, but generally lower. One of the keys of healthcare, who pays for most healthcare in the United States? There's really two people that spend most 90% of it. It won't be you. Who's going to pay for most of your healthcare? So Medicare is part of it, Medicare, Medicaid, VA, but who's going to pay the rest of it? Your insurance. which means most of your healthcare is going to be paid by your employer, which means if employment rises, people are unemployed, there's going to be less healthcare. So healthcare is a little unusual. Financials, we usually think as being higher beta. It can be a little unusual. Tech used to be high beta. It's hard to say today because it's so intertwined with our lives. Real estate is probably high beta. Utilities is low beta. People are going to pay for their electric bills no matter what. But people get debate on these numbers. I generally, especially when you're doing paper 3, I rarely go below 0.5 on beta. I rarely go above 3, except from some extreme circumstances. Where do you find beta? Well, we'll talk about that. You can find beta in Yahoo Finance, but that's a really bad beta. And I'll talk about why you don't use that beta. It's a horrible beta because it's just a very limited time period. So let's look at the sectors the last several years. So year to date, tech is the highest returner. Communication services, who's in there that's causing that so high? So that's Meta, right? Meta has just bounced back. Meta sold off down to like $90, and now it's up, $400 or whatever. It's just crazy. Who's done the worst this year? Energy, because oil prices just have not moved much at all. But still, everything's up pretty good. Energy 6.7. Last 12 months, energy is actually down. It's a very similar picture. Last 5 years, tech. Last 10 years, tech and energy has nothing. So when you get over 10 years, 500% sounds like a lot. If you annualize that, it might be like a 12% return or something, but it's pretty massive what tech has done. Communication services, that one's interesting because that didn't exist 10 years ago. That's a whole new category they created and moved Google and Meta in there. So I don't know, when I pull these tech, I don't know if Meta and Google were in tech 5 years ago, if they moved everything. It's hard to say on those, but it makes a difference which industry you are in. So I'm going to talk about probably in a future investment society. There's 2 strategies that work really well in investing, and they contradict each other. It's momentum and reversion to the mean. And how do you say that in a fancy way? Well, momentum is positive serial correlation. Y'all heard, y'all know what serial correlation is? Serial, not with an C, but with an S, serial correlation. What that means is something is correlated over time. So momentum means stocks that are up, keep going up. Stocks that are down, keep going down. That's momentum. What's reversion to the mean? The exact opposite. That's negative serial correlation. Things that did really well are going to do what? Below average. Things that have been below average are going to do above average. Which of those works? Who knows? Momentum works really well short term. Reversion to the mean works really well long term. If you're believing in momentum, what would you invest in? Tech. If you think of reversion to the mean, what do you invest in? Energy. So which of those will work? Well, it depends on how good your math is versus everybody else. If you're you're a hedge fund manager, most hedge fund managers have momentum in their strategies because it is so predictable. It's like the easiest thing. Which stocks do you buy? The ones that have been up the last 52 weeks. Which ones do you avoid? The ones that have been down the last 52 weeks. It works. It really does work. But when it doesn't work, like in 2000 and tech stocks crash, it can be really painful. All right, let's do this. We're going to skip to the C. We'll come back to the U. C, capitalization or size. That's just the size of the company. Here's my categories. We do large cap, mid cap, small cap, micro cap, and penny stocks. Those are my categories. You can ignore micro cap and penny stocks. Micro cap, we're talking companies I could probably buy. We're talking really small companies. Penny stocks, I could probably buy them, but I wouldn't want to because they're worthless. So large cap, that definition changes all the time. 20 billion, you're talking about Meta and Apple and Microsoft being $3 trillion companies. Is 20 billion still a big company? Yeah, kind of. That's maybe more mid cap. It's hard to say. It changes over time. Definitely 100 billion is still large cap. 10 billion is mid cap. So it kind of depends. So don't get stuck on those dollar amounts because they do change over time. Mid cap, a billion. A billion's really small for mid cap, but a billion to 25 billion. Small cap, 100 million is pretty small for a small cap, but 100 million could be small cap. Up to 2 billion. What's a unicorn? Have y'all heard unicorns?
Yeah, of course.
Yeah, but as a stock. I don't know what it has to do with horses with, well, maybe it is. What's the one horn on the unicorn for stocks? It's $1 billion. So when a startup firm hits $1 billion, it's a unicorn. So $1 billion is somewhat of a psychological number. 300 years from now, they'll probably be a unicorn, probably be $1 trillion company or something, you know, this number's gonna be much, much higher. Why do we care? Well, because these companies act very, very differently in different markets. Long-term, small cap has been the place to be. There's a famous guy named Fama. You may have heard of Fama French. Capitalization is one of the most important inputs to their models. And historically, small cap have beaten everybody else, and they talk about that as the small cap premium. That's not true recently because of what those Magnificent Seven have done, those massive, massive companies have done. So be real careful on question 2. Large cap is lower relative return and lower relative risk. Don't on exam 2 say, hey, if we expect a recession, I want to do more large cap because they're low risk. They're not low risk. They're lower risk than small cap. Small cap is higher risk than large cap. They're both high risk, but large cap is lower than small cap. All right, so it's a relative thing. So if you expect a recession, large cap will probably outperform small cap because small cap may not survive. These are companies that need everything to just work out perfectly. Now, there's a couple of types of small cap companies. There are small cap companies that are young companies starting up. There's also small cap that are big companies that used to be really big that have now shrunk because they're going out of business. You have to kind of decide between those two. Which would you rather have, an up and coming or one that's declining? You have to kind of decide which you think is cheaper. So small cap will have a higher expected return than large cap, but are going to be more volatile. You don't want small cap in a recession. They're going to sell off a lot more than large cap. So generally reduce small cap, increase large cap, expect weaker times. So now we got 3 pieces. You expect a recession. All right, I'm going to reduce my stocks overall. Within stocks, I'm going to move from cyclical to defensive, and I'm going to move from small cap to large cap. If I expect a strong economy, I'm going to increase my allocation to stocks. I'm going to move to more cyclical stocks, and I'll make it go down in small cap. So you got to think those 2 things together. I mean, recession implies 3 things now. I say generally. Why do I say generally? Well, there are people who think small cap are so cheap right now, it really doesn't matter. I'm over allocated to small cap because they are so ridiculously cheap right now. If we have a recession, they probably won't do well, but over the long term, I think they're going to outperform just because they're so much cheaper now. Not everybody believes that. Mainly because the big, massive and Magnificent Seven are so dominating. People think small cap day may have come. When people say, yeah, don't do small cap anymore, that'll never work again, that's usually when I want to buy them. We usually don't call the world's changed forever. It will never go back to the way it was. We don't call that very well. What about mid cap? Just put it in between. Mid cap has actually been doing pretty well. So you can get these shifts. Here's over time. So the large cap has had an average return of 10.25, small cap 10%, and mid cap 10%, and small cap 9.65. So the last 20 years, large cap has outperformed. But what do you, in the white line here is large cap. What do you notice about large cap versus small cap and mid cap? Up until COVID, small cap and mid cap were beating. Then you had the crisis, and where do you want to be in a crisis? You want those big stable firms. So you see how large cap is caught up, but you notice large cap won, but it's like this was like a 10-mile race, and they came ahead in the last 20 yards. So most of this time period, large cap has been the underperformer. And you can see it's quite wide in this early years, small cap and mid cap materially outperform large cap. And that's been the story. That's why you talk about the small cap premium. Small cap has been the place to be for a very, very long time. And it's just here recently that large cap has really taken off. And small cap is the one lagging behind, but not for most of this period. Small cap and mid cap have done extremely well. Comments on that one? So what is a small cap company? A lot of times it's companies you haven't heard of, but some of them you have because they're hitting the news. I don't know where Spotify is right now. I don't know their ticker. What's Spotify's ticker? Spot? That makes sense. So what kind of company are they? 76 million. Already a large company. Their PE ratio is 149, so it's also a very expensive firm. What about? See if I can think of us. Well, let's do. What about Netflix? What do you think? Large cap, small cap, mid cap? You would think large cap. They're pretty well established. 309 billion. Boy, I don't know small cap firms off the top of my head. Well, let's try this one. Macy's. What do you think Macy's is? Used to be large cap. What do you think they are now? 4 billion. Definitely small cap now. So that's one of those companies that used to be big that's now small. When's the last time you were in a Macy's? What's Macy's biggest problem? They're usually in malls. When's the last time you went to a mall? Some of y'all may have never been to a mall. My generation, we grew up in malls. When our parents were irritated with us, they just sent us to the mall, and the mall just babysat us for 3 or 4 hours. But y'all don't do that anymore because you have online. So, boy, if I can think of what about Intel? Still large cap or not? When you drop 60% in a year, it's still large cap, but it's dropped from 49 bucks to 22 bucks pretty quickly. It did shoot up here recently because there was some discussion with them. Kind of interesting what's going on in semiconductors right now. But the large cap companies because those are the ones you hear in the news all the time. The small cap, there's a lot more of them. They tend to be purchased more by retail investors, so they tend to be mispriced more often. They tend to be more volatile. So there may be opportunities there. They're dangerous companies because they can go out of business pretty quickly. They can be taken over. They can be exciting because they get bought out by another firm, like Amazon buying Whole Foods or something. So you can kind of get bought out. Let me give you one last one because I'm kind of curious about this one. If I can find it, it may not be there. Is Weight Watchers still publicly traded? It may not be publicly traded anymore. How's Weight Watchers doing?
Haven't heard of them in years.
So there's a new drug now, right, that people can take. That's just devastating these type of firms. So yeah, that's been devastating for them. I can't bring them up. We used to own Weight Watchers years ago. So small cap gives you a lot of really interesting. One thing I love about small cap, especially really small cap, the 150, 200 million, $300 million companies, is if you had a portfolio of 20 stocks back in the early 80s, and 19 of them went insolvent. So 19 of them you lost 100%. And one of them was Microsoft, you would have made a fortune. So in small cap, you don't have to be right 20 out of 20. You only have to be right 1 out of 20 and you'll make a fortune. But there's a good chance all 20 of them would do badly. That's kind of nature of small cap. But it's exciting with small cap. You can really, really bet. If I were investing like you are today, I'd probably take a portion of my portfolio, maybe 10% of it, and be putting these small names and just let it ride and hope I find the next Microsoft.
What's the difference between like small cap stocks or like 200, like the companies like 200 million or 200 billion? No, 200 million, sorry. And a penny stock, like,
Well, penny stocks are usually firms that are worthless. They're out of business. The only reason they're trading is because the stock is there. They haven't officially shut everything down. So like GM, when they went under, you could trade their stock and it could move 50% in a day. And that's just because some short sellers who got it right. They sold it for 20 bucks and it's now worth 50 cents. They want to close that short position, so they have to buy it back, and that'll cause it go from 50 cents to 70 cents. But eventually it's going to be zero and it's going to write the stock off.
Okay.
So penny stock traders are essentially trying to capture those short sellers and kind of get them and then get out real fast. So you're buying something that's really worthless, but it still trades because they haven't shut it all down yet. So they're really dangerous transactions to do. You better know what you're doing on that. All right, the S on style. So this one, we're gonna have some debates. The last investment society meeting, I didn't quite agree with their definition. Not everybody has the same definition. So I've been reading the Mondoran's books. I really recommend you get his books. They're really, really good. He was talking about value versus growth. So value versus growth is, you saw it in William Sharp's paper. So that term existed when he wrote this many years ago. It didn't exist so much in the 70s. So this is more the 80s, 90s when this came around. So what is a growth? What is a value stock? So technically, when it was first created, it's really simple. The Russell 3000 index, they just took every stock, took their price to book ratio. So what does the stock market say it's worth versus what the accounting say it's worth? And firms with high price to book ratios were at the top of the list, the lowest were had the lowest, and they just split it in half. The top 1,500 price to books were growth stocks, the bottom 1,500 were value stocks. It was that simple. Just valuation. So growth stock is an expensive stock or it's a fast growing company. A value stock is an inexpensive stock or it's a company going out of business, low growth. All right, so it's an eye of the beholder. The way the Motorin explained it was, I like his definition as well. A value stock is a company that's being priced entirely on existing assets, what they have today, because the market doesn't see them having many new prospects in the future. A growth company is valued a lot on future things they're going to do. So they look expensive because a lot of their valuations is on things that are not even in their book value yet. Whereas a value company, they're like, they've done everything they can do. They're just going to be making money off what they currently have. Nothing new is going to happen. Now, here's a real trick. You got to be really, really careful. You hear the word value, put it in your notes. Value does not equal quality. Value stocks are low quality companies, not high quality companies. A lot of people heard the word value say, oh, those are quality. That's not. Growth companies are high quality. Value companies are low quality. It makes it real important when you're talking about strategy. The reason they're value companies, the reason they're cheap is because something bad has happened to them. They may have too much debt, their earnings may be declining, their revenues may be declining. So value companies are troubled companies. Something I just mentioned, Weight Watchers, right? That's not a growth company at all. So if you remember that value companies are low quality, what do you want to do in a recession? If you expect a recession, what do you want to do with value companies if they're low quality companies? What do you think you want in a recession? High quality companies or low quality companies? High quality. Growth does better in recessions. Value does better in strong economies. Because value companies need strong economies. They may not survive in a recession, right? So keep that in mind. I remember when I first tested that because my assumption was, well, growth companies do well in great economies. And then I realized when I ran the numbers, like that's not true at all. Growth outperform in weak economies and underperform in strong economies. Now, one other thing you'll see with growth versus value, because value companies, their valuation is based on what they currently have, and most of their value is going to be coming in the next 5 or 6 years. You can actually use a term we talked about with bonds. You can think of value companies being short duration and growth companies being long durations. Growth companies, their valuations are way out into the future. So if you expect interest rates to rise, that may be a problem for growth companies. Now, it's not precise. It's kind of weak. It can be pretty unreliable, but generally, Growth companies do better when interest rates are falling. Value companies do better when interest rates are rising. And that's that duration play. It's not perfect. GMO, which I highly recommend you get on their website, they have had several articles on value versus growth. They are right now pushing value companies. And they had an article about a year ago where they said, we're pushing value companies, even though people are expecting a recession, and even though people are expecting interest rates to fall. And they said, we admit that's when most people want to be in growth stocks, but we're still pushing value stocks because they're so cheap right now. And so you can see they even acknowledge interest rates falling, weak economy, growth is the place to be, but they're saying right now growth stocks are so expensive, you still want to have value stocks. And I'm over allocated on value stocks as well, because they are just so cheap. But if we have a recession, I may regret that solution. Growth stocks are expensive. Why? Because Nvidia, Microsoft, Apple, these stocks are they're taking off. They are growth stocks. They have high price to earnings, high price to book ratios. Value stocks have low price to earnings ratios. Growth stocks grow fast. Value stocks are probably in decline. So growth stocks do better in weaker economies and when interest rates are low, while value stocks do better in strong economies when interest rates are rising. Generally, that word generally should be in there. Where is it? I didn't put it in there. Add the word generally. Not everybody agrees all the time. It's not a perfect thing, but it does work. One thing I love to do, you might try this, is I'll start with $1 and I'll have it appreciate with growth stocks. And then or even better, you have $1 growing with growth stocks, $1 growing with value stocks, and I'll actually subtract them. So when the line's above zero, that's when growth is outperforming. When the line's below zero, value is outperforming. And you'll see some incredibly predictable cycles. The late 90s, growth took off. And then what happened when 2000 hit? Value took off and growth took off. Where are we right now? Growth. Growth has been the driver. I'll even show it to you. So the white is the S&P 500. The orange is growth. The yellow is value. You can't see, you see back here, you can't really tell. I should have done a log normal. You see how value is way ahead? It kind of moved together, and then the last 20 years, the last 10 years, growth is just dominating. If you're a momentum person, jump on the growth bandwagon. If you're a reversion to the mean, like I am, jump on the value wagon, because value is really cheap right now. And it's really interesting in the 2000, 2010, 2015, all these articles come out and saying value is the best place to be long-term, there's where you should be, because value has so materially outperformed over the long term until these last 10 years. These last 10 years is one of the longest periods of time when growth is just really dominated. What's one argument you can make for that? Is the AI argument. AI is going to change everything. So it doesn't matter. Value stocks are going to go out of business. I heard one article I really liked said, going forward, every company is a software company. You're only successful if you're good at software. HEB is going to be a software company. UTSA is a software company. Valero is a software company. Tesla is a software company. I think people would agree with that. But is UTSA a software company? Yeah. Is Valero going to be one? Yeah. Everything's going to be software. Everything's going to be AI going forward. And you might argue that that's what growth companies are, and that's the only place it's going to be. I don't know if any of y'all use Duolingo. Is Duolingo a software company? Definitely. Is it an AI company? I'm trying to learn Spanish, so supposedly Duolingo is going to let you have a conversation in Spanish with an AI robot. And if you're flubbing up your Spanish, the robot will go back a few grades. If they speak to you on a 4th grade level, they'll go back to 2nd grade or 1st grade with me. They'll talk to me like I'm a 2-year-old, because that's the level I'm at. But at least I can. That's pretty incredible. Would you pay a premium price for that? Yeah, that sounds pretty cool. So, I mean, that's the key with AI. Right now, who's making money in AI? It's the firms that are producing AI for other companies. It's the NVIDIAs and Microsofts. Where we need to see AI really come in is where firms that aren't tech companies are using AI to make money, where UTSA is making money with AI. HEB, how does HEB make money with AI? I'd love for HEB, every time I go in there, I give them a credit card. They know everything I'm buying. I wish they'd take all that data and then the robots go get all the stuff, fill up my shopping cart for me. You know, I don't have to go and order it. They just look and they say, oh, you know what, you order this every 13 weeks or whatever. They could do that. They'd have to collect all the information. They have every single thing I've ever bought for groceries the last 20 years. They got a lot of data. Do you think AI could figure out what I'm going to buy next? Probably better than I can. In fact, AI will not forget the things I forget every third time I go. So that's pretty cool. So AI could dominate every single industry. I was listening to Valero. Valero has some really complicated processes of do we produce diesel? Do we produce ethanol? Do we produce gasoline? Who's buying? That process right now, I was shocked when they were here how manual that process is. You would think they have some super forecasting optimization, but it's very manual. Do you think AI could figure that out? Probably could. So AI is going to take over everything, which means what for you? You better know AI. You better be learning. Are y'all using Copilot? So if you don't know Copilot, go get Copilot, have it write you Excel macros and test it. Make sure you're doing that. You're going to have to learn AI. As the CEO of NVIDIA said, AI is not going to take jobs. People who know AI are going to take jobs from people who don't know AI. So does UTSA have machine learning classes? Does UTSA have AI classes for business majors? You should be demanding that. You need that. It's really, really important. Can you find out on the internet? Yeah, there's plenty of free classes out there that shows you how to do that. I put a comment on that on AI. I'm letting my security analysis class use Copilot for research. And so most of my students are telling me, their professors are saying you can't use AI. And I put that out there. A bunch of alums came out and said I use AI every single day on my job. It's extremely important to my job. So you better be learning it. I've kind of thrown in the towel. Y'all need to be using AI, but you can't do plagiarism, but you got to be doing it because you're going to be doing it on the job. So start learning that. So does that mean the orange just stays ahead? I don't know. I'm not convinced that we're going to get that exactly right. I think some of these cheaper stocks can catch up. All right. What about outside of the US? Here's the other area. I'm starting to get interested in this because these non-US markets are really, really cheap versus the US. But they're cheap for a reason. These other markets are not doing as well as the US economy. So the subcategories here. So we said on beta, you got cyclical and non-cyclical. On cap, you got large cap, small cap, and mid cap. On style, you have growth and value. So here, what do you have? You have developed, emerging, and frontiers, those three markets. So we've already talked about the US market. Developed markets, it's very precisely defined because MSCI used to be Morgan Stanley, but MSCI and S&P, they tell you exactly who's developed, who's emerging, who's frontier. They have that spelled out. And they're probably very similar between the two of them. I think there's been some debate. South Korea, is that developed or is that emerging? Taiwan is developed in both. South Africa is usually emerging. Israel is usually developed. There can be some debates, but I think the two of them agree, and they have a criteria. They have a list of things of what you need. I'll show you some of those criteria. So developed are larger markets like the UK, like Australia, like Japan. They're more stable. They have a similar return to US, but their daily standard deviation is actually lower than the US because of currencies. Currencies actually diversify them. And it's interesting how currencies work. So the Japanese investors, stock investors, do they want a weak yen or a strong yen? So a weak yen does what for Japan? It makes their exports cheap. Do you think that sounds good? Does Toyota want a weak yen so they can sell more cars in the US? That sounds good to me. So a weak yen is going to help Japanese exporters. So that's good for their economy. But what else does it do? It makes and it causes inflation. It doesn't cause much inflation in Japan, but it causes inflation. There are some negatives to it, but generally stock markets like their currencies to be weaker because it helps the exporters and it does help earnings. It can hurt their local consumers because it is inflationary. It makes imports more expensive. So it's not an obvious thing. So that's where you get the diversification. There's good stories for weak currencies. There's good stories for strong currencies. So it's not obvious if Japan's stock market's crashing, the yen's also crashing. It's perfectly possible that a strong yen can cause the Japanese market to go down. So you get that diversification. So that helps you some, but currencies are an important consideration. If I'm going to invest in Japanese stocks, I'm making two investments. I'm investing in Japanese stocks and I'm investing in the yen. So I need to have an opinion on both of those. I'll show you some numbers here to show why it's so incredibly important. Emerging countries, these are fast growing, developing markets. They're going to have higher expected returns, higher risk. They do have diversification benefits, but not as much as we've seen in the past. These stocks are especially really cheap right now, mainly because China has so collapsed their stock market, and China is a big part of the emerging markets. So China's come down so much that it's brought everybody else down. You can buy individual emerging countries if you know what you're doing, know what you're talking about. Most people buy just a basket of a bunch of them around the world. They can be interesting. They have had their period of time where they performed extremely well, and they've had their periods where they've sold off really dramatically. I can't say much about frontier markets. These are countries that are really in bad shape, maybe civil wars, hyperinflation, but they have a stock market. Their stock market may have 3 stocks in it. Who knows? I wouldn't touch these markets because I don't know anything about them. If I were you, if I were back at your age, and if I wasn't so horrible at learning languages, I might be tempted to move to one of these countries because the key here is knowledge. If you find one of these countries that's going to do well, like the Congo, you got all these precious earth things that they're producing. I don't know if I could, it'd be pretty dangerous. These are countries that are really struggling, but they are in the middle of EVs and some other things. Some people think Africa, because of solar energy and the high energy use of AI, that Africa could become an AI hub because, man, you can put a bunch of solar panels out in the Sahara Desert and produce. And the Economist had a really interesting article and how efficiently they can produce energy there, and AI could really use that. So there's some stories there. If you had the guts to move one of these countries, learn the language, learn anything about it, you could be incredibly valuable as an investor, unless it ends up like South Sudan or something where it's just, everything's just falling apart. So it'd be dangerous, but it might be worth it. But high risk, incredibly high return. Who knows? So here's how the Standard & Poor's defines it. The B frontier. Now, there are some countries that are not earning frontier because they don't have just minimum. The capitalization of the stock market, I mean, look at that number, $2.5 billion. What is Apple right now? 3 trillion. So you have to be 1/1000th the size of your entire stock market needs to be 1/1000th the size of Apple to count as a frontier market. The turnover has to be 1 billion. That's how much is traded every day. Apple probably trades more than $1 billion every single day. So these are really small numbers. And the exchange development ratios. So one thing that really gives China a problem to become a developed market is you take their stock market and divide it by their economy, and how much is that stock market? US, our stock market's about the same size as our economy. And China is a really small percentage. And so that keeps you from becoming a developed market. That's probably the number one thing that keeps China from being a developed market is their stock market's a small percentage. Emerging has to have all of these, plus actually it can't be 2.5 billion, it has to be 15 billion in capitalization, and then 3 of these others. Settlement T+3. So if you buy a stock, has to change hands in the next 3 days. business days. That's T plus 3, trade plus 3. At USA, I was doing trade plus 0. You can actually trade and settle same day. So in US, we're much faster, but T plus 3, you gotta have at least that. The sovereign debt, the country's debt has to be at least double B plus. I work in Costa Rica. I was shocked. Costa Rica is single B. That is a low debt rate. It's like scary. You know, people think of Costa Rica, the stable country, travel place, no military, all these wonderful things. But single B debt, that's pretty frightening. What's China's credit rating? Does that make sense? A plus? That makes sense. That would make, what's the US? Who knows? What do you think Canada is? Boy, that makes sense. Y'all know the US was downgraded by S&P a few years ago to AA plus because of their having that fight on the debt ceiling. So it can be an issue. What about Argentina? What is CCC? That's pretty terrible. Why are they not B? When you y'all loan money to Argentina, this country defaults constantly. And then people loan them again and they default again. I mean, I think they set a record. I don't know. We could see how many times has Argentina default. See, it's already up there as a choice. 9 times. Would you loan money to a country that's defaulted 9 times? But they're triple C rated. They have a new president, so there's a place of opportunity. A new president, he's pretty squirrely. I was talking to my Spanish teacher in Peru. What do you think about this new president of Argentina? He's interesting. He's kind of bizarre, but he's done some things that have excited investors. He hasn't gotten their credit rating back up. How do you borrow money when you're triple C rated? So that's one of the criteria. You got to be at least double B, but double B or double B plus. Double B is below investment grade, but double B plus is not a bad rating. No hyperinflation. What is hyperinflation? They have a chart, or they did have a chart. There's their inflation there. So $1, one mark. If 1 mark bought you a soda, at the end of this, it would have cost you, well, that's hundreds, thousands, millions, billions. So a soda would have cost you 1 trillion marks. People are like having wagons full of billions of marks, and by the time they walk from their house to buy a $2 trillion piece of loaf of bread, it was now $7 trillion. So they had to go back and get more currency. That's hyperinflation. Can't do that. Who's experiencing hyperinflation right now? You've seen a few countries that are certainly having inflationary issues. Foreign ownership restrictions, that can be an issue in countries like China and other places where they'll just say, hey, you can't invest unless you're a resident of this country. And then the currency has to be freely traded. You have to have at least 3 of these, but for developed, they have to have all of those. And this last one is the per capita. So let's see, US per cap GDP. So in the US, that's $65,000. S&P says it has to be at least 15,000. Whereas China now, anybody know China's per cap? Is it over 10,000 yet? Up 12,000. So they're getting there, not quite to that 15,000 level. What about Luxembourg? What is theirs? I don't know how to spell Luxembourg. Is that close? Oh, that's better be higher than that. What about UAE? I don't know if it gives it or not. I've mentioned the Congo, about 2,000. Sudan, $1,000. You know, generally extreme poverty is like $2 a day. So $2 a day is like $800. So, you know, these are very, very poor countries. Very poor. My word, you got all these civil war. I mean, the people just can't. They can't. There's no industry because everything's just in turmoil. These countries probably wouldn't even be frontier markets. South Africa is one of the wealthier ones. 7,000. You look at a country like Japan, 25,000. So that's important GDP from S&P standpoint, because it's going to tell you how stable the environment is and who can invest. They had it at 15,000. I don't know how often they update that number to a higher number over time, but 15,000, could y'all live on 15,000 a year? I could in Costa Rica. Because it's pretty cheap to live there. You can build your own house for like a couple $1,000 and you don't need air conditioning. So I could live off the land, but it's tough. Where we work in Costa Rica, the per cap in that area is about $5,000, but there's an indigenous people group that per cap's like $500. Very, very poor area. And they get by somehow. So there's a wide range here. That's one of their requirements. So that's what a developed market is. You can see how these different markets have done. So here at the US, average return of 10%. Developed markets over this time, this is 20 years. The US is up 10%. These markets are up 6%. You can see the huge difference. Emerging markets only up 7%. Here's China. Look at China. China was number one, and then suddenly it's dropped down to almost last place. See how China has come down pretty dramatically. And so emerging markets is going to be somewhat influenced. You can see how emerging markets was doing really strongly. Emerging markets was the best. And now it's come down. IFA, the problem I have with IFA, and it's hard to tell which one is IFA, the orange one. You notice developed markets is like never in the top. They just never do well. How many Metas and Googles and Amazons can you think of in Europe? Just don't exist. See that the big companies in Europe are really old companies. It just aren't a lot because it's just tough to create a big company in Europe because of the labor rules and other things. Here's Japan. Japan's up about 8% over that time. And that's even with Japan hitting all-time highs again. You can see Japan shot up here recently, but still well behind the US. So does that make you want to invest in the US or to get out of the US and move somewhere else? If you look at the long term, US, other than emerging markets in China, US is pretty consistently a strong performer in those numbers. So this almost makes you want to get into emerging markets, doesn't it? Emerging markets that had a really good run and then they've been off here recently. So if you're a reversion to the mean, it's hard to make a reversion to the mean argument for developed markets because they've never been. There's nothing for them to revert to because they've always been it and also ran. Questions on that? So how do you handle currencies? Most investors don't hedge. They put 10% in Japanese stocks, they got 10% in Japanese stocks, and they have 10% in the yen. That's just the way they do it. There's a few people who will hedge, but hedging, a lot of times people think hedging just reduces your diversification. You might as well just invest in the currency. One thing you can do if you believe there are people with skills, and this is something you could Google, it's a pretty interesting topic. But there are portfolios called currency overlay. Have y'all heard that before? Currency overlay portfolios? So what you can do is say, okay, we're gonna go out and we're gonna buy the countries we think are really good. We think we're gonna put 20% in Japan, we're gonna put 10% in UK, 5% in France. But we don't know currency, so we're gonna hire another manager and they're gonna take those allocations and they're gonna go long and short on different currencies. So we might be 10% or 20% in Japan. But they can say, you know, you like Japanese stocks, but we hate the yen. So we're gonna buy Swiss francs and we're gonna short the yen. And so they'll overlay that on top of it. So you have like a currency portfolio on top of your stock portfolio. Does that work? I don't know. It could. So where do you want to be? You want to be where productivity is improving the best. It doesn't have to be the best productivity. It just has to be improving the best. And that's going to be dependent on education in that country, which most countries, that's a big issue. It's going to be infrastructure. It's going to be just business formation, how easy it is to build a formation. It's going to be immigration policy. It's going to be really, really important. We know in the U.S. immigrants generate over half the new jobs in this country. So immigrants are huge for job creation. Yeah, the book I just read just talks about how it's just amazing what immigration does to community, and just the job creation is pretty phenomenal. So you need good immigration, you need good government regulations. One thing you can look at that you used to be able to look at is this thing that the World Bank did, was the ease of doing business. You'll notice that it's a few years old, and that's because they stopped doing this report because Russia started cheating, and they threw in the towel because Russia started playing with the numbers to get them higher on the list. Who's number one? New Zealand. Have any of y'all been to New Zealand? I've always wanted to go bike riding there. Singapore, Hong Kong, Denmark, Korea, obviously South Korea. United States is number 6. I don't understand why y'all think Georgia should be number 7. How many of y'all started business in Georgia? I don't mean the state of Georgia. I mean the country of Georgia. I mean, it's a pretty dangerous area, isn't it? You got Armenia, Azerbaijan, you got Russia right there on the side, but somehow they're number 7. I don't understand that. UK, you would understand that. Norway, you see a lot of the Scandinavian countries, that somewhat makes sense. Lithuania, that one doesn't quite make much sense. I mean, you've seen these countries on the border of Russia that are high on this list. That to me seems pretty interesting. Mauritius, how many of y'all would invest? Y'all know what Mauritius is? Anybody? So off the coast of Africa. So there's your first African country. I have no idea. If you look on the map, it's just a little dot. And it's not right off the coast. I mean, you couldn't swim to it. I assure you, it's pretty far off. But I don't know, Mauritius, yeah, that's the only African country in the top 13, Australia, but it's ahead of Australia. Taiwan makes some sense. UAE makes some sense. North Macedonia, does that make sense? That's like a brand new country. I don't know how Estonia gets in there too. So there's some countries you kind of have to wonder, is this really a good list or not? Or are these countries playing with the numbers? I could probably move to Mauritius and start a business. I wouldn't mind living on an island. That'd be kind of fun. But you know, who knows? Who's at the end of the list? Somalia, that makes sense. Eritrea. So 2 countries right next to each other. Venezuela, does that make sense? Venezuela would be on this list. Do any of y'all want to start a business in Venezuela right now? Yemen, you got the middle of the war, you got the Houthis, and you got this big, everybody bombing each other. Yeah, that's probably not a good place to start a business. Libya, South Sudan, Central African Republic, Timor, I don't know where Timor is. Y'all know where Timor is? Off the end of Indonesia. I don't know why they're so low on the list. It somewhat makes sense, right? The countries you're seeing, that what they're saying is you go in and start a business, it's going to be frustrating. So I mentioned Costa Rica. Costa Rica has a lot of benefits, but starting a business, I don't know where Costa Rica lists. Oh, there it is, 74th. Costa Rica is not a good place to start a business. We started several there. We have a charity that starts business. If you start a restaurant, it is a pain to start businesses there. My friends in Costa Rica, I got them a USAA checking account because I wanted to get money to them faster. We arrived at USAA at 4:55 p.m. and we left at 5 o'clock with a checkbook and a bank account. And Alex says going, yeah, that takes like 3 to 6 months in Costa Rica. What we just did in 5 minutes takes 3 to 6 months in Costa Rica. It's a pain to do anything. Costa Rica could immediately increase the per cap of its country by just lessening up some of its ridiculous requirements. We produce coffee in Costa Rica. It's really good coffee. I'd love to export it to the US. No way to do it. It just costs way too much. It costs more to export it to the US than the coffee costs. So we charge $10 for the coffee and then it's $25 to get it here. Just ridiculous. If their government wanted to make their people richer, they could do it overnight by just eliminating some really horrible. Where does India line up here? You may guess. High or low? Would you want to start a business in India? I don't know if I can find it. Can I do a search? 63rd. What is Modi doing to try to make India more business friendly? India protects its homegrown businesses very carefully, which I think does it more harm than good. And that's what a lot of countries do. It's like we don't want new companies coming in because we want to protect our companies. That just destroys their economies. Would this help you as an investor? What you'd be interested in as a firm that's moving up this list because they have new government. That's why people are interested in Argentina. I don't know where Argentina falls in here. 26, 126. So people are interested. It's not because they think Argentina is great, but because it's changing. So as an investor, it's the delta, it's the change. So you don't care that they're wanting 26 if you think they might get the 87th, because that means their stock market's going to do well. So as an investor, you don't mind that they're low on the list, as long as you think they might move up for some reason. And if you want the details of this, here's the entire report. This is just the last one you can get. And they go in detail on all the pieces that they look at. It can be things like how hard is it to buy a piece of property? And how well are your property rights protected? I mean, do you want to build a new house or a business in a place where someone might walk in and say, no, this is my property now? Probably not. How hard is it to start a new business? What happens if you go bankrupt? How hard is that to get out of the business? Bankruptcy laws. That's one thing with India, that they're trying to fix their bankruptcy laws just so firms can go under faster. If it's a pain to go under, what's going to happen to start a business? If it's going to be a massive 20-year nightmare, if your firm fails, what are you going to do? You won't start a business, right? So those are the kind of things they're looking at. The banking system, all of those things. So they have a list in here somewhere that goes through all of those things. It's a pretty lengthy report. Greater ease of doing business associated with higher levels of entrepreneurship. Obviously, starting new businesses is really important. Starting business, dealing with construction permits, getting electricity, registering property, getting credit, borrowing money, protecting minority investors, paying taxes, trading cross borders, enforcing contracts, resolving insolvency, your bankruptcy laws. Those are the things that they're looking at. So as an investor, it's intimidating because there's so many things you have to look at, but it's also exciting because there's so many things to look at. This is somewhere you can become a real expert. If you have language skills, or if you've grown up in another country, it gives you a huge advantage. If you want to go back to that country and become an expert, do business in the US, it certainly gives you an advantage if that country has some prospects that make it a good place to invest. What's going on in Mexico right now? New president, but what's the big story in Mexico? The former president, what is he doing? I've seen all these new constitutional things that's going to make Mexico a much worse place to invest. So what is Mexico's stock market doing? Selling off. I actually think the new president, I kind of like her. She's kind of interesting. I like her relative to the existing one, and she's trying to undo some of the stuff he's going to do. It'll be interesting to see. But as an investor overseas, you got to know a lot of what's going on. It's much more complicated. And then if you're going to invest in companies in those countries, then you have to learn a whole another set. So it's complex. It's a lot of stuff. But if you're willing to do the homework, you can be an incredibly valuable member of a company. Right. So if you have language skills, advertising, it's extremely important. I've had several students get jobs at HP just because they spoke Spanish. The founder of the Investment Society, his first job at Goldman, he was their emerging market desk person. He was speaking to people in Spanish in South America, so his Spanish skills helped him. If you have a foreign language, you might think about being an international investor and learning that. I mean, you can make a lot of money because there's a lot of money being invested around the world. The other thing that's important, obviously, is education. This is an old PISA score, but y'all know PISA, that's the educational, those standardized tests. Where does the US rank? Way down here on math, here on reading. I don't know how we rank like that on science. How are your science classes in public school? Are they good? Mine were pathetic. You should have seen the exam we had on the human heart. He had one of his teaching assistants draw it. She had everything in the wrong spot. Like I just ripped it up and drew the heart by hand. It was terrible. We didn't learn anything. How many of y'all had health classes taught by a coach? Yeah, did you learn anything in that? It's pretty pathetic. So I don't know how we ranked. I actually had really good math teachers. But you've seen the videos, right? They go around and ask people really simple questions, and it's pretty embarrassing. But there's the US. We've got to move up higher. How do we move higher? Who knows? We got to reform public schools. We got to do something different. I think at a minimum, we should have public schools. So I'm pretty radical that any kid in the United States should be able to go to any public school in the United States, regardless of zip codes. I think we start with that. What would happen if you do that? What would happen to bad schools if you did that? They go out of business. What would happen to good schools? They'd be oversubscribed. What do you want to have happen? Exactly that, don't you? But I think we should actually have public schools in the United States. If someone in San Antonio wants to go to school, public school in Dallas, they should have the right to do it. They have to get their own transportation, but it should be there. Instead, what do we do in the US? Have you heard of that woman whose son was in a really bad public schools? So she fibbed on her address and gave her like her cousin's address. What happened to her? You may have heard that story. She went to jail for 5 years. That's what we do in the US. So we got to do something. I'm a big believer in competition. I had some horrible public schools that could have been much better. I had some wonderful public school teachers. My English teacher in high school, she was the best. Actually wonderful. I had all good math teachers. I had horrible science teacher, horrible history teachers. So it just depended. We could do a lot better in the US. These countries, what are they doing that's so good? Who knows? You can go to each one of them. They're all very different. We've got to get better at education. But who knows? When it comes to international stocks, there is a growing trend to not talk about US, developing, emerging, and frontier, but instead of talk about global large cap, global small cap, global mid cap. So they say, let's break it up a little differently. Do you really care between Exxon and British Petroleum, BP and Exxon? I mean, they're global energy companies. Do you really care? One's in the US and one's in the UK. They're just energy companies. Or maybe some industries are global, like energy, but some, like consumer services, are local. So maybe you break up the world like that. So, there's different ways to do it. I give you the more standard approach. But you can go as precise. Remember, parsimonious. So you could say, okay, I got US stocks. I'm going to break those between cyclical, defensive, small, large, medium size, growth and value. And then I got developed markets. But you could go further. You could say develop large cap, develop growth, develop value, develop small cap. You can have as many categories as you want. So you got to decide, will it help you as an investor to break out developed markets between large cap and small cap, between value and growth? So you have a lot of choices here. You want to be parsimonious. So you don't want to break them up just to break them up, because that gets really, really difficult. But you can certainly get the data. There's no doubt the MSCI and S&P has developed market large cap, developed market growth. They have those categories. There probably are exchange traded funds out there that have those categories. You probably don't have a lot of history though, so you may only have 5 years of data, so you may not be able to go back and look historically at them. But certainly they're possible. The US small cap do the same things that developed market small cap, or they're a completely different category. So there's a lot of research you can do. So you can get out there and get more precise with how you define your markets. So somehow combine countries and sectors and capitalization in some different ways to try to find something that really explains risk a lot better. So this is an area, again, this is an area you could specialize in, just depending on your aptitude. If I were doing this, I'd really specialize. I'd find one company. I've always wanted to move to Botswana. Maybe I go to Botswana. Probably too late for me. I don't know what they speak in Botswana, but it just seems like a really cool country. It's one of the best economies in Africa, so this seems like it'd be cool from there. I've never been to south part of Africa, so it seems pretty cool. So if I were 20 years old, yeah, move to Botswana, learn the language, start some businesses there, start connection with the US, probably become a multimillionaire in Botswana. That'd be pretty cool, right? Any of y'all have the guts to do that today? You know, if you did it, you'd be made for life. I mean, you'd have it for life. If that country actually turns out as well as Botswana has. This book by Jim Rogers, you might look up Jim Rogers. I think he's still living. He's getting up there in age. He's an international investor. He writes really good books, and he's fun to listen to on YouTube because he's brutally honest. He says shocking things. So he's pretty cool. He moved his family to China because he thinks Asia is going to be the place to be going forward. And then he moved to Singapore because he couldn't take the pollution of Beijing. But both of his daughters are fluent in Mandarin, and you know, that was just something you got to be fluent in Mandarin because that's what it's going to be. Some people think Africa is the future because of the young population and all the precious minerals that they have and the energy. Africa has a lot going for it, even though it has a lot of political issues. So he talks about those kind of things. This book, I really, really like this book. It's huge. It's a massive book, but Why Nations Fail. So from an investor standpoint, he's going to ask, why was Argentina one of the richest countries in the world in 1900, and now it's a disaster? Why didn't they keep going? Why couldn't they maintain that success? Why is the US worked out, but other countries haven't? And is it culture? Is it mineral resources? Is it proximity to a coast, to a shipping channel? Is there politics? What are those things? And they go through that in detail, and they have a very precise solution at the end on what they think distinguishes one country from the other. I would recommend you get it. I listened to it on Audible. It works pretty well, Audible. The reason it's so long is not because their theory is so complicated. They explain their theory, and then they go overboard in proving that it works. They go back hundreds of years, and they prove over long run, the countries with these attributes do well, the countries with these attributes do horribly. If you're an investor, that's what you got to know. So you want to know their list. If you don't want to listen to that long book, then here's one of the great courses, Foundations in Economic Prosperity. Is essentially that book, but in a college course. But it's short. It's like a 20-hour college course. In fact, an alumni, so you got to hear this course. So I got it and was listening to it, and I said, that's the exact book I just read. And then throughout the course, he kept referencing that book. So he essentially took that book and made it a course out of it. So that's pretty good. This guy, Runshir Sharma, he's at Morgan Stanley. He writes some good books and has some good blogs. You might look him up. So yeah, these are good books. There's Jim Rogers right there. So I'm not watching gold. There he is. He's getting a little bit chubbier, but he looks about the same. Boy, he's getting a lot chubbier, but you can see just the way he's talking. He's quite animated. He really gets into it. You might not like what he says, but he's very brutally honest, and he says stuff no one else is saying. It's just why I like listening to him. He's a pretty intense guy. China will be number one. That's kind of what he's been saying for quite some time. That hasn't worked so well the last few years. There he is again. So he's a good guy to listen to. Very, very animated, very interesting. Here's a Why Nations Fail. And then Sharma, I got his book. It's an interesting book. He talks about the 4Ds. So the 4Ds for him are, I think I might have it on the next page. Let's see. Or is it in here? Oh, here they are. So depopulation, we might talk about depopulation. So people aren't having babies anymore. The world's shrinking. So that's a big one for him. Globalization is now, that's one reason why Germany is struggling so much. Germany is a globalization country. It relies on exports. And Germany is really struggling right now because there's this anti-export because of the battle between the US and China. Deleveraging, governments around the world have so much debt. We're going to have to do something about that. What happens in a deleveraging when people are having to pay down debt? That's not good for markets. And de-democratization, if you survey people in Latin America about their views of democracy, they're not very popular, not very favorable toward. That's pretty scary. You're seeing more and more autocrats taking over, whether it's Putin or whoever, Maduro and Venezuela. So he says those are the driving forces going forward. Which countries win? He mentions Germany's going to lose, the US will win. China will probably lose in that because China is a very export driven unless China's population itself starts going. So he doesn't just say what are the 4Ds, but he says which countries win, which lose. So it gives you a strategy for where you want to invest your money, and that's what you're looking for. So I recommend him. He's a very well recognized and respected person. If you go into Bloomberg and use WEI, you can get all the markets in the world and see what's going on in all the markets. Pretty good site. All right. Questions on any of that? We might look a little bit more at some of these 4Ds next class. All right. I'll stop it there. So we finish up stocks. Y'all remember bucks? Anybody remember bucks? Give me all the pieces. So B for beta. What's the definition of beta?
Risk relative to the markets.
The market or the economy? What the two subclasses? That's style. Don't get the style yet.
No,
Cyclical, defensive. What's your strategy? Remember, two-pronged strategy. Stocks overall, and then cyclical defensive. What do you do with stocks overall? Your strategy? Expect a recession.
Lower your allocation to stock.
Reduce stocks. Expect a recession. What do you do with cyclical and defensive?
Increase or overweight defensive.
Yeah, within stocks, overweight defensive. So then you have US versus non-US. So there you got, you remember the subcategories there?
Develop,
Emerging, frontier. Okay, and there you got to make sure you talk about currencies in that one. And then you've got the C, which is capitalization. What's your subcategories there?
US large cap, medium cap, small cap.
Large cap, medium cap, small cap. Which one do you prefer in a recession?
Small cap.
I mean, in a recession.
Oh,
large.
Large cap. Yeah, large cap, small cap do better.
Should we buy small cap stocks in a recession?
Well, the question is not where you are, but where you're expected to go. So that's a good point, especially on the second question. So you don't want to say if rates are rising, short duration. You want to say if you expect rates to rise, short duration, because if rates are rising, it's too late. So if you're in a recession, yeah, you might buy small cap there because they've already sold off. So you want to be real clear in your answer. If you're expecting a recession, move from small cap to large cap. If you're in a recession and everything's already blown up, yeah, you might be buying small cap at that point. That's a really good point. It's not where you are, it's what you're expecting to have happen. And then style, growth versus value. Buying growth stocks, expensive, but much higher quality firms that have a lot of growth. Value stocks, cheaper, but cheap for a reason. Weak companies, value companies, because they're weaker companies, don't like recessions. They tend to do okay when interest rates are higher because most of their value is today. So that's everything we're looking for there. All right, let's look at alternatives, which is just everything else and depends on who you are. So at UTSA, real estate was not an alternative. It was a separate asset class all into itself because we had like a $3 billion real estate portfolio. But for a lot of people, real estate is an alternative. So it just depends on who you are, how you define it. We're going to break it into real assets and other. We're going to focus on real assets. We're not going to do a lot of the other alternatives.
in your intro to alternatives, there's two things you got to bring up. Why do we like alternatives? The number one reason people talk about alternatives is diversification. They tend to be not as highly correlated, especially today when we're talking about stocks and bonds hate inflation. So when inflation takes off, they're both going down. Alternatives is where you try to find something that is going to help you against inflation. So they help you with diversification, and they often, especially real assets like real estate and commodities, can definitely help you against inflation. Now, last night, if you're at the investment society meeting, that definition of commodities was not correct. They gave them credit for it, but that wasn't correct. I'll talk about commodities and the way we use it in finance. I understood what he was saying, that you go to Walmart to buy commodities like food staples, but that's not the definition of commodities we're going to use. All right, so make sure you have that in your answer. Diversification and hedge against inflation, especially for real assets. So real assets are those things you can pick up and touch. So if you buy stocks, yeah, you can. We used to have physical securities that say you own Apple stock today. It's all electronic, but that's not what Apple is. Apple is it's ownership. It's a right. It's not an actual physical asset. So with real assets, we're talking about things you can touch, you can pick up. So probably the biggest one there, and probably the biggest asset class in the world, is real estate. So what's the expected return? Real estate. So real estate, y'all know what real estate is. You're buying buildings, houses, land. We struggled with this at USAA because I had this job. It was one of those times where I was sitting at my desk, minding my own business, and I got a phone call that says, Ron, you're now working over here. And there's a whole new department was set up. And it was pretty hilarious because I hadn't been involved in this for years, but there was a big debate at USAA is why do we have so much real estate? The guy over at investment company, he hated real estate. He wanted us to sell it all and put it in stocks and bonds because that's what he did. The real estate people, guess what they wanted? They wanted to keep real estate. I'd worked with both departments, and so they asked me to come into this department, but I was in the investment company. So they were assuming I was coming from the investment company, I was going to hate real estate, but they didn't know I was they're undercover. I actually like real estate, so I came in and made a strong argument for real estate. But one of the things we struggle with is what is the expected return on real estate? Because we don't have really good historical data and we don't have trustworthy data, especially on the risk of real estate. You can't really look at it. Stocks and bonds, we have all this public information. We have daily prices. Real estate is not like that, so it's kind of tough. So we did a lot of studies on real estate. We wrote a massive paper on it. We read articles. One thing I strongly recommend that you do that I got in the habit of doing, I read an article I really liked. I would call the author. And guess what happened? They would talk to me. One guy we talked to, Dan Cashman, we read his article. I thought it was fascinating. We called him and said, I can't believe I read my article. It's great. He talked to us forever. So yeah, you see someone wrote an article you really like, just give them a call. And today it's easier. I don't even know how I found people back then. Somehow I got their names, but just call them and talk to them. It's pretty amazing. And so we had to come up with the return expectations and risk. We essentially said real estate falls somewhere between stocks and bonds. They don't have as high as return of stocks, but they have a higher return than bonds. And most real estate is heavily levered by debt, which makes it riskier, but also gives it a higher expected return. So that was our assumption. You'd have to see all of our studies to see that. A lot of people think real estate is low risk and low correlation, but that's absolutely overstated. It's not true. And the reason for that is we don't sell real estate every single day. So if you're trying to figure out how much your house is worth, what are you going to look? You're going to look at houses sold in the area recently that are similar to your house, but you don't actually know the daily return of your house like you do of your stock portfolio. And most real estate, like at USAA, we got a return on our real estate every month, but most of that return is appraisals. It's not market values. We don't know what the market value is. It's an appraisal, and we have something called appraisal smoothing. Appraisal don't change their prices the way the stock market changes prices. And so it makes real estate look a lot less risky than it really is because we're smoothing that out.
Real estate did y'all buy?
USA's main real estate, the thing they like the best was build to suit. These, you build, Amazon needs a big warehouse, or someone needs to build a big factory for AI or whatever. That's where, I don't know why they made so much money on that, but they made a fortune. I didn't understand why they built something for Amazon
got all this rent, and then finally sold it to somebody else. Why Amazon didn't just build it themselves? But that was their biggest one. They were heavy in the hotel and kind of travel and leisure. They own, you know, the La Cantera over here. Used to own Fiesta, Texas. I guess I can tell you inside information, but USA sold Fiesta, Texas. And do y'all know how much USA got for it? So when's the last time you sold something and you had to write a check? Yeah, have you ever sold a car, you had to write the person a check? That's how USA sold Fiesta, Texas. We sold it and we had to write a check. So that's how bad of an investment Fiesta, Texas was. But they do office, they do retail, but their biggest ones was build to suit because they were just making a fortune on that. Which talks about the categories of real estate. You can break up real estate geographically or by property type. Geographically, there are really set regions in the US. We're in the South. And it's hard to tell if Texas is South or West. It depends on whose your definition is. So it's geography, then property type. So hotel, office, retail, industrial, apartments, malls. I don't know if anyone's investing in malls anymore. But those are the categories. Now we have infrastructure. We have some other unique categories. And you'll probably specialize in some of those. USA did retail, did office, but those weren't their primary office that they did. There are some real estate companies that all they do is apartments. You can certainly specialize. NACREIF is a great organization. Let's see if I can find NACREIF. Let's see if I get into it. See if something comes up. The premier U.S. institutional real estate. Why institutional? We're talking about big pension plans, big investors buying massive amounts of real estate. You're not going to be a real estate investor if you got $10 million to invest. You can buy houses, but you can't, you know, some of these buildings are, you know, $50, $100 million. So this NACREIF is a great place. It's an association, so it's not actually a company. They used to, but they've switched this, but they used to provide data online, but now they don't. But they used to provide real estate returns by property type, but it came quarterly, not monthly, which is a big issue for us because when we were looking at stocks and bonds, we were looking at monthly returns, but with real estate, the most you could get was quarterly. But even with quarterly, you didn't believe the numbers. So first, second, third quarter were real nice and tame, and then fourth quarter was really volatile because that's what everybody did their appraisals. So you had this kind of a mess of data, but they did provide data, but now you got to pay them money to do it. So they'll give you the most recent return, but you used to be able to click on it and get, you know, 30 years worth of quarterly returns. We use that data as much as we could. The returns are probably correct over time. So eventually appraisals catch up with actual market values, but the volatility was grossly understated. Real estate, when you use their data, looks less risky than treasury bonds, but we know it's more risky, but it's just that appraisal smoothing. Y'all understand that appraisal smoothing? You know, it's not a market price. It's a guess evaluation. We have the same issue with private equity we'll see here. So NACREIF is a good place. I'm just not a member and they don't provide that information anymore. So real estate is very illiquid. You're not going to sell real estate as fast as you can sell stocks. Stocks are about the most liquid thing we have out there other than maybe T-bills. Real estate is very illiquid. Takes a while. So I always talk about the Sears building in Chicago, which is no longer the Sears building. I can't remember the new owner. Have y'all been in the Sears building? They got that observation deck at the top where you can walk out on glass. I hate heights. One of the banks had dinner at the top of that building. I hated that whole thing. All I could think about is only because the building sways. I don't like eating dinner when the building's swaying 18 inches. So that whole time I was like, I just want to go down, get out of here. How quickly could you sell that building? 6 months, maybe, if you're lucky, but maybe probably 2 or 3 years. It's going to take a while. It's a massive amount. It used to be the tallest building in the world, not even close anymore. And which of these properties would you prefer? Well, they're all very, very different. Hotel has what we call short duration. What does short duration mean? It means that they can change their rates every single night. So if inflation takes off, they can increase their rates. So hotel tends to be less interest rate sensitive. Office tends to be very interest rate sensitive because you might lease out to a government entity for 10 years or 20 years. It looks more like a 20-year bond than it looks like real estate. So real estate can have this, each one of those property types has its own type of risk. Retail can obviously be really, really risky, especially during COVID. A lot of these firms pay rent plus a percentage of revenue. So during COVID, you could see your real estate could just be devastated. And we're seeing, obviously, a lot of people are getting out of real estate. Industrial is a place where USAA did deliver extremely well because there are, you may not notice it, but these business parks with these massive buildings, that's the place to be. Those are really safe investment. USA made a fortune. I was just shocked at some of the returns. When USA built Fiesta, Texas and USA Towers, they're kind of horrible investments. That was free. They had new management come in, and Ed Kelly came in, and then oh my word, they had a whole group of them. They just redid USA's real estate, and they really, their numbers just got a lot better. Really, really well-run company. But they focus on assets that you don't normally focus on because that's where the value is. Do we have real estate majors in here? Maybe a couple. It's an interesting field. You can certainly do really well. I used to have contacts at USA's real estate company, even just a few years, but most of them are retiring. So I'm kind of losing my contact there. Now, is there a way we can make real estate liquid? So there's something called a real estate investment trust, the REITs. Have y'all heard of REITs? So what a REIT is a company that does nothing but real estate, but does it as a traded company, as a stock. So you can buy that company as a stock, but it's really real estate. And a REIT is defined by the US tax code is as long as they pay out a certain percent, as long as a certain percentage of their income is real estate related, and they pay that out as dividends, they're tax-free to whoever they distribute to. If you buy a REIT, you have to pay tax, but the REIT is tax-free. So anything they earn is tax-free as long as they pay dividends. So a REIT is a tax-free entity. When you receive it, you got to pay tax, but still you're getting that extra benefit that they're getting higher income because they're not having to pay tax. So that's what a REIT is. It's very liquid. So it looks like we created this wonderful thing, right? We're getting real estate with liquidity. We can sell our stock in a real estate company. The problem is when you run numbers, REIT stocks correlate mainly to small cap stocks, not to real estate. They look like small cap stocks because that's what they are. So they don't provide that diversification. If you buy REITs, you're really buying small cap stocks. It's just the way they operate. One of the funds I took over for USA, I won't give you the name of it, but it was supposed to be a really well diversified portfolio. And it was 25% stocks, 25% bonds, 25% REITs, 25% gold, which is insanity. That fund almost blew up and went out of business. Fortunately, it did all that before I took it over. When I took it over, it was 60% stocks, 30% bonds, and 10% gold or something like that. But they had 25% in REITs, but the argument that that's real estate. And they quickly discovered REITs are not real estate. They're very volatile small company stocks. So that fund, and gold is ridiculously volatile. So they had 50% of their portfolio in two really, really, really volatile, almost destroyed it, that fund. So I do not believe, and you may find some of you might get a pension plan, or you may be working some client that they consider REITs their real estate portfolio. I don't believe that at all. They just do not perform like real estate. They're very volatile. They look like small companies. So I'd be really careful on that. There are other companies besides REITs. There's REOCs, real estate operating companies. They're essentially the same thing, but they don't get that tax advantage. So the tax advantage is to the REIT. The REIT doesn't pay tax, but the investor does. And you got to be really careful because if you buy REITs as a corporation, most stocks give you the dividends received deduction because REITs are not taxable. When you get REIT dividends, you don't get the dividends received deduction. So you got to be real careful. REITs have some tax quirks that are a little bit complex. So whenever you take our illiquid asset and you try to make it liquid, it tends to cause that asset class to become more correlated to the stock market and become more volatile. So illiquidity is part of the greatness of real estate. The fact that it's not traded in markets every day, that you don't know what's going on, it kind of protects you from all that volatility. Once you convert it to a stock, you're gonna pick up all that volatility.
Do REITs do better in higher or lower interest rates?
Well, REITs have a high dividend yield, just like utility stocks, which means they're almost bond substitutes. So what do you think they do when rates rise? They usually do very badly. They tend to look like bonds. REITs have high dividends because the tax law. Utilities have high dividends just because of the nature of the business. So you'll generally see REITs and utilities sell off when interest rates rise. It's not 100%, but generally you will. All right, here's a good site. I don't have the right, you don't need all of that default at the end. So just REIT.com. What is a REIT? You always have one thing about real estate, you have great pictures, these wonderful glass shining buildings everywhere. So this is a trade organization that's pushing REITs. They're pushing REITs as an investment. So that's what they want to do. USAA may be well, USA is not USA anymore. I don't even know what the new real estate company is called. They spun off the real estate company because of government regs, but I don't think USA was part of REITs. They were part of private REITs. So you can do a private REIT where it's only it's traded over the counter. You can't buy it on the market. So it's possible USA's old real estate companies part of these public REITs now. USA does not have a public REIT that it has traded. So they're advertising, trying to get you to buy REITs. They hired Ibbotson and Associates to try to prove REITs are real estate, that you can use in your portfolio as real estate. And what they did is had Ibbotson do a study, and Ibbotson came out and said, REITs used to look like small cap, but now all of a sudden they're starting to look more like real estate. And I found that, wow, that's really interesting. And I looked at their numbers and I said, they're exactly right. The last 3 years, they're right. But the 1 year since they've done their study, it's all gone back and REITs are now small cap again. So there was a short period of time where REITs kind of looked more like real estate, probably during a real estate market. So they might, you look at NACREIF. NACREIF is going to talk all about diversification, diversify your portfolio, buy real estate. The REIT site, they may try that argument, but they're going to have a little trouble getting it to stick. And I think they know that. So it's tough. If you're going to do real estate, I would do real estate. I'm not saying REITs are a bad investment, but I would buy them as part of your small cap stock portfolio, not as part of your real estate portfolios. It's just not going to work. What about residential? We're not going to cover it. I used to say that's a retail market. That's us buying our houses, but then BlackRock has destroyed that. BlackRock is now a huge investor in residential real estate, making people very upset. And Airbnb is changing the market too. Where I ride my bike, this guy was selling his house. I was talking to him about it, and he was trying to find a buyer, and he had all these people visiting. And finally, he just gave up and converted it into an Airbnb. What do you think the neighbors think about that? Do you want an Airbnb across from you? So far people have been friendly. I'll say good morning to them, and they're usually pretty friendly, unless they're from the Northeast and they're like, why are you talking to me? But most people have been pretty friendly. But it's an Airbnb. So even the residential real estate part, I don't know what BlackRock's going to do with all these houses. It's been pretty interesting what they're doing. I do know people in your category, coming out of college, maybe have some money from an uncle or something that are actually buying real estate to do Airbnb. Have any of y'all tried that, or your family? Good friends of mine just moved out of New York, but they have the most incredible condo in New York. They just sold it for probably millions. Can't even imagine. It's like a 3,000 square foot condo in Upper East Side, just gorgeous. And they say, oh, you can stay here for free anytime you want to. Where do you stay out of town? I said, yeah, that sounds pretty good. Now they've moved, so I've lost that. But I asked them, would you Airbnb this? And their association says, no way, you can't do that. And if their doorman, doorwoman sees a stranger coming in multiple times, they're going to, turn you in. So, but you could make a lot of money, couldn't you? Airbnb in a place like that, that would be pretty lucrative, but some places just don't want you to do that. So the residential side has definitely changed. I know people that's their market, that's what they do, but you better own 20 or 30 houses if you can get that to work. But we won't cover that here. We're going to focus on commercial real estate. All right, let's talk one of my favorite asset classes, timber. So what is timber? Timber is a wonderful thing. We're gonna talk about commodities next. You notice I put timber between real estate and commodities because it is both. Timber is people who own land and grow trees. Trees, lumber is a commodity, but the land that it's on is real estate. So it's in between those two. It's a wonderful, wonderful asset class. It is extremely well diversifying, mainly because it's a local market, because trees are really heavy. You're not going to ship trees from Texas. I don't know if y'all know Texas is a major timber state. Your friends up northeast think we're all desert and tumbleweeds, but people don't realize how many trees East Texas has. East Texas is like gorgeous. Have y'all been to East Texas? Gorgeous part of Texas. Gorgeous pine trees. It's really beautiful. So Texas is a major tree, but you're not going to cut down trees in Texas and ship them to China. It's just they're too heavy. You can't put them on a boat. So very localized market. So they tend to give you that diversification because they're so localized. They tend to have pretty good returns. They do tend to help you with inflation. You can have different types. You can have pulp. You can have construction, hardwood. Some people say, well, timber must have done really horribly in 2008 when the housing market crashed, and it did badly, but not as badly as you think. Timber kind of can hold up pretty well because it has different uses. So it's an interesting asset class. And one thing I like about timber is if you have a timber farm in a place where, people are moving, the suburbs are growing, and now it's more valuable as real estate than as timber. You can sell it as real estate, or you can sell half of it, or you can have people come on for hunting, or what. If you have that real estate that you can make it real estate. So you have those options. Another thing we love about timber is what happens to timbers when markets are bad. So if you buy oil and you like oil prices, so let's say you have 500 barrels of oil in your backyard, and you don't like oil prices, so you say, I'll just let it sit back there until oil prices come back. What's going to happen to that oil while it's sitting there? Not much. It's just going to sit there. Kind of boring. If you don't like the prices of orange and you got 20 million oranges in your backyard, and you say, well, I'll just wait till orange prices come up. You can't do that. What happens if you don't like the price of timber? What happens to that tree while you're waiting? It's growing. That's what we call store it on the stump. It's a wonderful asset class. If you don't like prices, you just wait, and while you're waiting, you've got more product. It's kind of a really wonderful natural thing. So we love that from that standpoint. HTRG, let's see if their site's still working. They got bought out and merged or something. Okay, what's the main color we're going to see when we click on this site? Green. Why are all timber companies just green everywhere? We love these trees that we're going to rip out of the ground here in a few months. They're real sensitive to that because obviously we know trees are a major carbon capture. But what do timber people say? Yeah, we cut them down. We also replant them. So, they're on both sides. They are very, very sensitive. Every button on here, green, 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 everything's green. That's just their sensitivity. Why timberland? They're probably going to talk about diversification. I haven't looked at this. It's probably in there somewhere. Growing global demand. Zero, the zero, I mean, it's a little tricky. It is true that trees do capture carbon. Well, what happens to that carbon when you cut the tree down? It releases it again. So it's a temporary kind of thing, but they are pretty important. So yeah, they're arguing, why should you have timber in your portfolio? Now, if I were you, I'd be really tempted. I've never had a student do this, but if you're a finance major and you really like being outdoors, well, it'd be really tempting to me to go to Texas A&M, get a forestry degree as a graduate student and an applied job here. We talked to a couple of timber guys. One guy who came in a suit, and we're like, "You're wearing a suit?" Yeah, I almost never wear a suit. I'm almost always in blue jeans and a t-shirt because I'm out in the forest. And so that's my whole department wanted to quit because they were all hunters. Let's become timber guys. It'd be a pretty good career, right? Because you'd be so specialized. This is an industry that's probably going to be around for quite a while, if not forever. Been around for thousands of years. That's the kind of specialization that would be pretty cool. I don't know if I'd be good at forestry because I'm not good at science, so we have to see if I could actually do that. And I assume A&M has a forestry degree. I doubt UTSA has a forestry degree, but it might But that kind of specialization, I mean, you're set for life. You just need one graduate degree, you learn that, you go get the job. And this would be the firm you might work for because it's the one of the largest ones out there. So yeah, I don't know what job opportunities they have. Here's their team. Thomas Sarno, look at that, got a PhD. And one thing you should do if you do want that kind of career is go find the senior management and the middle management and see what degrees they got and what schools they went to. Because you probably want to get some background on what is the insight on this market. I don't know any of these people. And what's the diversity? Not seeing a lot of women. So if you're a woman and want to do timber, you would probably be 100% assured of a job. Because this is a very undiverse part of finance. Any questions on timber? I think that could be your career. That's a really exciting. That would be really lucrative place if you trying to find a place that specialize. And the guy we talked to, he was from this firm. They changed their name because they got bought out. But he was finance and he knew timber backwards and forwards. Have y'all seen how they cut down trees now? So there's no more lumbermen. It's a big machine that comes in, grabs it from the base and just rips it out of the ground. It's pretty amazing. It's not something you want to see because it looks pretty anti environment, but it's much more efficient. All right, so commodities. This is a huge one. Obviously, there's a lot here that you can do. We tend to break up commodities between energy, agricultural, and metals. We'll look at FinViz here in a second. You can buy an exchange traded fund. We'll talk about this later. You can buy a mutual fund or exchange traded fund that does commodities. You got to be really, really careful when you do that because they are not the same. So S&P has one. It's 60, or last time I looked, it was 60% energy. Dow Jones AIG had one. It was only 31% energy. So you really want to look at those three categories and look at the allocation between the three of them. Make sure you're not just investing on energy, because obviously energy in 2020 nosedived quite a bit. You'll be in really bad shape. Those websites might or might not work. This second one, I've had a tough time finding ETFs on that second one, mainly because it's got AIG in there, which went out of business essentially. But you can find some background on them. If we look at FinViz, FinViz does a great job. Some of y'all might be using FinViz in your paper. So you look at the futures. So it starts off with stock markets. And then it goes into energy. You can say it says energy over there, oil, both WTI, West Texas, and Brent. These two prices used to be the same, but you see how far off they are now. Gasoline, heating oil, natural gas, ethanol. So there's your energy. You have interest rates over here, bonds. You have your agriculture, cocoa, cotton, orange juice, coffee, lumber, sugar. Then you have your metals. You have some other down here. Yep. So you have agriculture, soybeans, corn, wheat, rough rice, oats, canola, live cattle. You got a lot of agriculture, lean hogs, live cattle. So, and then you have your metals, gold, silver, platinum, copper, palladium. FinViz does a great job of giving you this information. You can click on these charts, see the history. So like in Costa Rica, we do a lot of coffee. So I'm always interested in coffee. And see that coffee prices have rebounded quite significantly. I always call Costa Rica. I'm kind of curious if the world market of coffee has the same impact of those local farmers, and they generally do. They do see when these prices are up. We do a lot of banana in Costa Rica too, but you notice banana wasn't one of the things listed there, so I can't show you what banana prices have done. But yeah, coffee has had some big cycles. Sometimes you'll see, like all that's going on in Colombia right now, obviously it's a very country that's in a lot of turmoil after the last election. When a country produces a lot of coffee and something like that happens, you can see coffee prices really respond to elections. So it can be interesting. Cocoa, we just seen recently with what's going on in Ivory Coast and Ghana, that can have a spike on prices. So when you do commodities, you got to know who are the producers and what's going on. Like gold, a lot of gold is produced in South Africa, and a lot of the miners there went on strike. You can see gold prices. So there's a supply and demand, and supply. You see a big frost in Florida. What happens to orange juice prices? They're probably going to shoot up. So you have to be somewhat knowledgeable of who are the major producers, some understanding. This is another area you could spend your entire career on. You could pick one of these commodities and make that your entire career. You want to do lean hogs for the rest of your life, that could be your you would figure out which farmer is producing them, what's happening with some of the diseases in China where they're actually slaughtering millions of pigs because of that disease. What is that doing to prices? You would be an expert on that and be trading that. You could make that your entire career. I think more than likely you probably would have 3 or 4 of these that you follow and be a trader on. That could be your entire career. So with commodities, the key again here is diversification, maybe more of a strength argument for inflation. So one thing I wanted to test that I haven't gotten around to it, that's another thing you want to sit down with me and we test it. But people always say buy gold to protect you from inflation. But in 2022, that didn't work. Gold didn't go up in 2022. But what did oil do in 2022? It shut up. So I want to do an analysis is buying energy, not energy companies, but buying energy, buying oil, natural gas. Is that a better an inflation hedge than gold itself? And the reason for that is gold is very sensitive to the US dollar. When the US dollar strengthens, gold doesn't do well. Whereas oil is usually priced in dollars, so it doesn't have that problem. But that'd be an interesting thing to test. Imagine you testing that, sitting down and testing that and bringing that up in an interview. The huge advantage I give you in energy would be really, really interesting. So is gold really the best protector from inflation? Tips, we talked about tips, those treasury bonds tied to inflation, actually paying inflation, they actually didn't do well in 2022. So of all the things we look at, energy is the only thing that would have helped you in 2022. So you can see it can get really tough to know where to put the money. Maybe you need to have not 10% of your portfolio in gold, but maybe you need to have 5% in energy and 5% in gold to give you a little bit more diversification. Most Americans don't buy commodities as a hedge. And so when we have inflation, they're just crushed. Because all they have is stocks and bonds that both crash in inflationary periods. So you might need to think about commodities. The wonderful thing now is they are easier to buy. Most major mutual funds and ETF, and we'll talk about ETFs more, they do have commodities as one of their options. Even energy, you can break it out into subcategories. So you can get a lot more liquidity on these asset classes and certainly purchase them. Questions on commodities? All right. And then one we're not really going to talk about, but other real assets, I don't know much about this at all. I do have some Van Goghs in my house, but they're all prints, so they're not worth they're worth less than what I paid for them. Artwork you could specialize in artwork. There's no question. If you want to work for some of these major art firms, it is a very unique market. Bitcoin might fall in this category. I don't know, but artwork, collectibles, cars, special type of cars, there's all kinds of things that fall in that category. This is old. I can't find anything. I forget what even year this goes through, but just so you can see the categories, artwork is broken up in impressionist and modern, old masters, 19th century, post-war contemporary, traditional Chinese works of art. Fine wine's in there. Maybe fine wine is like stored on the stump with timber. If you don't want to sell wine, you can let it sit there and it ages. I don't know. I don't drink wine, so I don't know if that really works. Stamps, one of the students in this class is a coin collector and he's really good at it. And he sees a coin and he'll buy it. Really good. Classic cars, I don't know anything about those. Rugs and carpets, rare musical instruments, jewelry, watches, even real estate if it's certain times of special type. And then there's the overall index. 90% sounds good, but I don't know what year this is from or two. If that's over 20 years, that's not all that good. And you can get even more specialized than this. So in Costa Rica, we had a guy that was the beetle guy. That was his real, beetles are a real asset. So what did he do? He went out in the jungles of Costa Rica. He took two beetles who had never, met each other, and he will mate them and create a beetle that has never existed before. And he will sell them for $500, $600 each. And he's extremely knowledgeable. He wanted us to give him $10,000 to invest to buy a research lab. And I said, I'll do it if you'll train someone everything you know. He's like, no, I'm not gonna tell anybody what I know. He's like, yeah, you're like 60, 70 years old. We're not gonna give you $10,000 and you die and it all dies with you. So that's just kind of where you didn't get to meet him, but yeah, he's a pretty interesting one. And his wife was the butterfly lady. So she collected butterflies. And I thought, wow, it'd be cool having a butterfly for a pet. She's like, well, they live like 3 months, so you're not a very good pet. But she would take the cocoons and sell those. And she'd sell those not for hundreds of dollars, but she would sell them. So you can get really specialized. You could do your whole career on these kind of things. But you're probably going to have some background in this or do some extra study, because this is an area of finance that most of us don't get into because we know we're going to get ripped off. It's just a very illiquid market. All right, so that's real assets, real estate, timber, commodities are the main ones we're talking about. They tend to have, they have good diversification benefits and usually help us out quite a bit in inflationary. You think about in the 70s, when we had high inflation in the 70s, real estate was a pretty good asset class back in the 70s. Oil obviously was a great asset in the 70s. So they do help you in those inflationary periods. Any questions on real assets? All right, another alternative I'm going to throw in there is venture capital. Venture capital. So venture capital is a little different than private equity. All venture capital is private equity, not all private equity is venture capital. So venture capital is startup companies, brand new firms starting off from scratch. It's a new venture, it's venture capital. Private equity is just something that's not traded on the public markets. So it could be an older firm. So we saw Dell Computer, Michael Dell took Dell Computer private several years ago. That wouldn't be venture capital because that was a massive firm. He's gone public since then. Burger King went private several years ago and now it's public again. So private equity is just everything that's a company, ownership in a company, but is not publicly traded. And then venture capital is just those startup firms. But specifically looking at venture capital, it's a way to buy those small companies, but you don't have to worry about the daily stock fluctuation because they're not publicly traded. And we talk about something called a J curve. So I did private equity at USAA. USAA did not do much private equity. So I inherited a portfolio of maybe $400 million, a really small portfolio. But someone had to do something. You can't just let 400 million just sit up there. So I was responsible for it. When they gave it to me, the woman that was doing it before, she walked over literally, I'm not exaggerating, with a shoebox and handed it to me. And that was all of her venture capital stuff. She didn't have it on the computer. She hadn't entered it. So here's our venture capital portfolio. It's just so small, no one wanted to mess with it. I put it all in the computer, look back at historical numbers. I want to see what kind of return we got. And essentially our return was the exact same return we would have gotten if we just stuck it in the small cap market. So a lot of work, but we had the J curve. The way the J curve works is if you're a pension plan, you want to do venture capital, you sign up as a limited partner and the general partner will come in and say, we have this $1 billion fund. You say, fine, I want 100 million of that. So you sign up for 100 million. You don't send them 100 million, but they'll eventually call and say, we need 10 million next week, or we need 15 million. So you send them money over time. And for the first 2 or 3 or 4 years, nothing. They're starting these businesses. They're probably losing money. They probably have no earnings at all. And then all of a sudden, many of those businesses start turning the corner and making money. So you get this J curve. You have a few years where you just spend money and nothing happens. And then suddenly, and most venture capital contracts are 10 years. For the first 3 or 4 years, nothing. And then suddenly, and what did they do at the end? What do you imagine happens in year 10? What do you hope happens in year 10? You want the venture capital firms to do what? Go public, IPO, or have y'all been studying IPOs? There's now 3 ways you can do them. IPO, y'all know the other 2? Say it again? Yeah. So that's what Trump did, right, with his company. And then what's the 3rd way? Was it Spotify that did this? Direct listing? So you avoid the investment banks. So y'all probably should study those. We didn't have those. All we had was IPOs. So you hope they IPO at the end. And USA has some really good IPOs. There's some Medtronic you probably heard of. That was one of the firms we had invested in, Charles Rivers. So we had some pretty good names. And we had a lot of companies that just didn't go anywhere. But that's what you do with venture capital. You're probably going to be wrong on the majority of your investments. But it's okay because it's the few that you're right on that make you a fortune. So if you get a few that are just take off, you can have one do well out of 20, you still make a fortune. So that's what you look at. But most of them are a 10-year rent window. It's a very illiquid market. And for the first few years, you're getting these quarterly reports that are completely unreliable because it's appraisals again. Your general partner is telling you what they think these companies are worth, but it's completely guesswork. No one really knows. So you're really just hoping it all turns out. You're waiting for it to IPO. My job was to sell the IPO. And like, I've never done this before. So you have to think again, you're in this job and no one wants to mess with it because it's only a few $100 million. So they give it to the newbie. So I'm the newbie. So I got to figure out what to do with this. And they're like, okay, if they IPO, you got to decide when to sell them. And so I did a study. And in fact, I was listening to Dr. DeMotor, and he was talking about when's the best time to sell IPOs. So I did a study. I discovered the optimal time is 14 days after IPOs. And so that's what I just started doing. I can't remember what that analysis was, just looking historically at IPOs. So that's what we did. We get an IPO, and then 14 days later, I took it to the trade desk and we sold our shares. So it was interesting. It was like 3% of my job, if even that, because it was just so small. And USA just never got in to this. The head of the investment company, his idea, if we're going to do venture capital, we're not going to go into a partnership with 50 companies. We're going to put all our money in one company and hope it becomes the next Microsoft. I was like, well, we don't have time to do that. So we can't, in that case, we're not going to do venture capital. I said, okay, well, let's get out of it.
How does the company go private if it's already public?
They just buy back all their shares since they take themselves over. That's essentially what a Life buyout is. You buy all the shares back from your investors.
What if, like, if we were to own shares, they would buy our shares without our consent?
Yeah, you can get voted on by, I mean, read some of the books on like Barbarians of the Gate. You get a sense of how that process works. I've never been on that side being bought out because I work for a private firm. So you can probably read some books on that. There's probably some pretty good websites, direct listing versus IPO versus spec. How do they work? So you can get all kinds of things there. So I would probably, if I were you, if you're not familiar with those, look those up so you know what they are. I think SPACs have kind of gone out of favor here recently. I don't know if they're still doing them as much, but they were real popular there for a year or so, and then they just got gone out of favor. Direct listings, I thought it was Spotify, but I can't remember. Why direct listing? So I don't know how well it went. You know, you keep the investment bankers kind of out of it, so you have some sense of what it's worth, and you just essentially you take your current owners and you just give them public stock, and then they start trading. I mean, it's essentially you just convert everything public. It seems a lot easier than IPOs, but I've never done either one, so I can't tell you how they work. And me, SPACs are really, really bizarre things. They're kind of like, give us some money and we'll figure out what to do with it, and then eventually we'll have something that trade. You know, just it seems. In fact, there's some questions about SPACs being a little bit, some ethical concerns about the people doing them. So who knows? I'm just not an expert in these. And then to your question, how to take a firm private. So essentially the stockholders get together and say, okay, Michael Dell, you can buy your company back. And that all works. I'm sure it doesn't happen in 3 days. I'm sure this is multi-month process, but any of y'all live in Austin, where all the Dellionaires live up in West Austin, those massive. So a lot of wealth there in Austin with Michael Dell.
But they can forcefully buy, like, they can buy my.
I can't tell you the details, so you have to look it up. I haven't been involved in a transaction like that. Dell is a pretty massive firm, over $100 billion in revenue at one point, which is pretty interesting because for a while there, they were losing money with $80 billion in revenue. I was kind of like, how do you lose money when you have $80 billion in revenue? But they finally turned it around. They are making money now, and Dell's doing some pretty interesting things. So it's an interesting firm. It's not just a computer manufacturer. But that whole process, I mean, do it as a case study, Luke, and just see how exactly they got all the shareholders to agree. So where are the big venture capital hubs? So they're usually surrounded by some major universities. So you got Boston, obviously you got California, you got Austin. If you want to work venture capital, you're probably gonna have to get your master's from UT Austin because they're gonna hire UT Austin grads. We do have a couple of venture capital alums from UTSA that are up in Austin right now. One in particular, John. I talk to him every once in a while. I go to Austin and visit with him. He's pretty bold. He likes that part of the world. And he's doing extremely well. But it's not easy to get into that side of the game if you're not coming from Harvard or UT Austin. They tend to be really specific. Now, what else is there? So there's a lot of other things out there. One of the biggest one now, I was going to show you an article. Maybe I'll show you next Tuesday if I can get it copied down. But infrastructure is a big one. So infrastructure is you're taking things like toll booths and other kind of government run things, and the government sells the toll road to a private investor, and when it comes to an investment, they tend to be fairly safe, predictable. What about other things that could be derivatives, hedge funds? I don't consider hedge fund to be an alternative. So you should at some point look up the hedge fund strategies. I don't know if you know hedge fund strategies. You can Google it. Most common hedge fund strategies. And you know, it depends on where, if you're certain jobs, if you interview with them, like with a pension plan or some major portfolio manager, you probably want to know. UTIMCO, you should probably know what these are if you go interview with UTIMCO. We did hedge funds at USA, but a very limited number of types. So long short equity, essentially, you might buy 130% in stocks and short 30% in stocks. So you have 100%, but you're long and then you're short. So it gives you ability to control your risk a lot better. Market neutral is your 100% stocks and your 100% short stocks. So essentially you have nothing invested. You have a $1 billion long and $1 billion short. So essentially you're trying to just beat the market. We did a lot of market neutral when I was at USA. I kind of like that strategy. In fact, our very first hedge fund, I never thought we'd get it done. We did a Deutsche Bank one. And I go, well, we'll try it. I really want to do this. I go to the CEO and it's like, he's not going to approve this. And he goes, yeah, we're going to do this. Yeah, I'm busy today. If y'all want to do that, that's fine. That's the only time in my entire career he did that. Every time else was like, you got to prove it to him. But we did a market neutral and we were very, very, very lucky. Usually you hire a hedge fund and right after you hire them, they have their worst year ever. We were so lucky in our first hedge fund. The year we hired them and they had like a 50% return. It was just wonderful. We're so like, so lucky. I don't know how they did since then, but we lucked out. Merger arb is two firms are talking about merging, are being acquired, and maybe the stock's trading for $40, but they offer $47, or they offer $50, so the stock price goes from 40, but not to 50, it goes to 49. So there's a buyout at 50, but the stock only goes to 49. There's a way to kind of arbitrage that out so you can get that $1 risk-free. That's merger arb. Convertible arb is you got stocks or bonds that can convert to stocks. And you're doing all the math behind that and figure out there's some type of arbitrage there. Some way you can make money without taking risk. Capital structure, you just get down to these strategies where they're trying to look at, are there ways we can structure these deals, structure the debt versus the equity in ways that if things work out, we make a fortune. And if things don't work out, we've got protection on the downside. So those are all common type. There's a lot of other ones in there. I would definitely know these first four because they're pretty common ones. But I don't consider them to be alternative asset classes. I consider them to be other ways to get alpha, get extra return in your portfolio, especially market neutral. Market neutral, say, well, that sounds like a stock market because you're buying stocks. But yeah, if you buy $1 billion in stocks and you short $1 billion in stock, it's called market neutral because you don't care if the stock market goes up or down. You just want the ones that you're long on that go higher than the ones you're short on, or the ones that you're long on don't fall as much as the ones you're short on. So that to me is not an investment in stocks. It's a way to beat the stock market. So I view it as extra return on top of the portfolio. And that's how we did it at USAA with the Deutsche Bank fund. So I consider them alpha plays, not beta plays. When you buy the stock market, that's a beta play, but you buy a market neutral, that's an alpha play. It's a way to add extra return to your existing stock portfolio. So I don't consider hedge funds alternatives. I definitely don't consider derivatives to be alternatives. That's just another way to get into markets. Currencies could be, we talked about currency overlay portfolios. You could have someone just manage your currencies. That could be an asset class, maybe, but you're usually going to do that on top of another investment like your international stock portfolio. But there are other alternatives. We'll see what the internet says. Major alternative asset class categories. See what they say. Here's Harvard. Can't get much better than that, I guess. Private equity, private debt. We didn't talk about private debt. Private debt kind of depends. You're talking about, there's a lot of private debt that I wouldn't consider alternative. USA did private debt all the time. So that's, I don't know. There is some that would cover there. They say hedge funds. I disagree with them. That real estate, yes. Commodities, yes. Collectibles, structured products. It depends. We talk about structured products in the debt side, like mortgage-backed securities. They're talking about kind of equity-linked notes, some really, really strange securities. That could be an alternative. I still think most of the structured products, it's just another way to get equities or bonds in a kind of a different kind of vehicle. So they agree with me generally, with the exception of I don't consider hedge funds to be there, but we're not going to cover collectibles, but they have them in there. What I think is interesting is they don't have infrastructure in here. And Harvard, I think, is a pretty big investor in infrastructure. So why they don't have that as a separate class, I don't know. So again, if you look it up, you can get a different answer depending where you go, because alternatives, everybody has their own definition. One hedge fund I didn't mention is Global Macro. They left it off the list. I wouldn't know what Global Macro is. We did a lot of Global Macro at USA. Essentially, what you're doing there is you're just telling your investor, go all over the entire world and go long on things you think are cheap and short things you think are expensive. And they can usually do it stocks, bonds, commodities. And so they might think the Japanese stock market is cheap and the UK stock market is expensive. So they'll buy Japanese stocks and short UK stocks. Or they might think UK bonds are really good and Swiss bonds are expensive. So you just tell them they don't usually buy individual securities, they buy entire markets because they're using derivatives. So that's Global Macro. Another one they didn't mention was I can't remember the name of it, but it's the timing traders, it's the momentum traders. I can't remember the name of it. We never invested in it. Maybe that's not I remember it. But Global Macro and that strategy, I can't remember the name of it, work really well together because they almost move in opposite directions. Like in 2008, this strategy that I can't remember, it's going to come to me as soon as we leave class. It did great in 2008 because it was a momentum. In 2000, I was a momentum trader in US in 2008. It was a really predictable market because it just went down. And people that are betting on that trend continuing, they made a fortune in 2008, and that's what these people did. Managed futures, excuse me. So managed futures, those traders, boy, they did great in 08. Global macro didn't do well in 08, so we're giving you that good diversification. So you're kind of looking for those kind of deals. All right. So for exam 1, question 1, in your own words, you can define what a portfolio is. You got 3 questions. You remember the 3 questions? What's the first question? Someone comes to you, I got 500,000 bucks. First question is what?
Why?
Why are you investing? Which is mainly focused on your horizon. The second question, what can you invest in? So you want to be parsimonious there. That's all those asset classes. You're going to spend most of your essay writing that, the major asset classes, and then breaking them in detail. And your last question, how? So you're going to do it yourself, hire someone, you're going to be active, passive, you're going to do indexing, those kind of questions. And then on the asset classes, cash, bonds, equity or stocks and alternatives. And on cash and bonds, you got to explain they're both loaning money. What's the difference? I mean, you got reinvestment risk and price risk. And then on everything else, bonds, you got DC cuts I, you got to define it, subcategories and strategy. Define it, subcategories and strategy. Same thing on stocks, you got bucks, define it, subcategories, strategy. And in stocks, make sure you give that introduction. And then alternatives, you got real assets, and then we have venture capital and other. If it's too much overlap with the class notes, the biggest mistake you could make is to start your answer by copying and pasting the class notes. That's going to destroy you. If I see my class notes, and I know my class notes very, very well, you're not going to get a good score. So anything that you almost verbatim take out of class notes, that's my words. I get credit for that. You don't get any credit for that. All right. I already know I've passed this class, so I don't need to grade myself. So put it in your own words. Again, the best, hopefully you've already been doing that. Read the class notes, listen to the lectures, take notes, read it over and over again, and take each one of those pieces and write it on the top of your head, off the top of your head, without copying and pasting it all. If you do that, you'll be in good shape. And then read your answer to other students in the class, compare notes, bring it by to me if you want to talk about it. Make sure it's well organized. I don't care about formats so much. You can use the 2-column if you want to, but you don't have to. It needs to stand on its own. So don't just throw terms at me, you know. So if someone comes to me with $500,000, they want to build a portfolio with blah, 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 blah. What I would do is ask them 3 questions, blah, blah, blah. You know, you make it all logical. If you want to do extra stuff, that's perfectly fine. I will give maybe some critical thinking points if you want to do some extra. I'm not asking you about doing research paper, but if you want to, you can certainly do that. You should have it pretty well written because the exam's coming up here one of these days. All right. Next class, we're going to work on exam 1, question 2. All right. So be ready for that. All right. I'll stop it there. Any questions? Everybody's good?